What if I told you that in just over 12 months, millions of Canadians could be financially trapped, not by a crash, not by a job loss, but by the government's own rulebook? Starting in 2026, a wave of new federal and provincial regulations will quietly roll out, and most people won't even see them coming. But experts are already warning, these changes could raise your bills, block your renovations, freeze your accounts, or even stop you from renewing your mortgage. Sounds extreme, maybe, but here's the part that no one's talking about. These rules are already approved or in motion, buried deep in policy documents, budget plans, and pilot programs. And when they go live, homeowners in cities like Toronto, Vancouver, Edmonton, Calgary, Halifax, and beyond could face sudden financial pressure they were never prepared for. These aren't conspiracy theories or what-if scenarios. They're real policies that could penalize you for owning a second home, flag your bank transfers as suspicious, or force you to report every asset you own, right down to your car and crypto wallet. So the real question is, will you be ready? Because today, we're breaking down the 10 hidden rule changes set to reshape life in Canada, and the steps you need to take now to stay one step ahead. Stay with me, the most shocking ones are near the end. Number 10. Home renovation restrictions. Starting in 2026, homeowners across Canada, especially in cities like Vancouver, Victoria, and Montreal, could face a new kind of renovation nightmare. It's called green renovation compliance, and while it sounds like an eco-friendly upgrade, for many, it could become a financial black hole. Here's what's happening. Under new climate policy targets, even simple home upgrades, like replacing a window or redoing your basement, may require mandatory energy audits, government-approved contractors, and compliance with new environmental efficiency standards. That means if your home was built before 1990, and let's face it, a huge chunk of homes in Canada were, you could be forced to upgrade insulation, electrical systems, plumbing, or windows just to meet basic compliance. And the kicker? You'll likely have to do this before you can even list your home for sale. According to housing policy experts, these upgrades could increase renovation costs by 20% to 40% upfront, with very limited rebates to help soften the blow. If you're thinking, that won't affect me, think again. Even routine repairs might trigger compliance requirements, and failing to meet them could delay your project, cost you thousands in fines, or block your ability to sell. So what can you do? Experts recommend getting energy audits done early, setting aside a dedicated reno budget, and working only with certified contractors who understand the new codes. Because in 2026, simply owning an older home could turn into one of Canada's biggest, and most expensive, liabilities. Number 9. Tighten bank monitoring. By 2026, your everyday bank account could become the center of unexpected scrutiny, not because you've done anything wrong, but because the rules around financial monitoring in Canada are quietly tightening. These changes are aimed at fighting money laundering and financial fraud, but the fallout could hit ordinary Canadians the hardest. Here's how it works. Banks across the country, from the Big Five in Toronto, Calgary, and Halifax, to regional credit unions, will be required to monitor your spending patterns more aggressively. That includes large cash deposits, frequent e-transfers, or even something as innocent as helping your adult child with a one-time gift. If any of those transactions don't match your usual behavior, they could be flagged. And flagged transactions may lead to account freezes, delays in transfers, or full-on investigations into your funds. What makes this worse is that these systems rely heavily on automation and AI. Which means false alarms are not only possible, they're expected. A legitimate home reno payment, a sudden large withdrawal for a funeral, or shifting savings between accounts could all trigger red flags. And here's the scary part, if your account gets locked for review, getting access to your own money could take days, sometimes weeks. This is especially concerning for seniors, gig workers, and small business owners in cities like Ottawa, Winnipeg, and Surrey, who often have unpredictable cash flow or irregular banking patterns. One flagged transfer could delay payroll, rent, or emergency expenses. By 2026, financial freedom might come with a new price, constantly proving that your own money is legitimate. And unless you're watching your accounts as closely as the banks are, you might not see the warning signs until it's too late. Number 8. New gig worker classification rules. If you're one of the millions of Canadians working gig jobs, freelancing, or clocking in remotely, get ready. In 2026, the rules around who is considered an employee versus a contractor are set to change. And the financial fallout could hit fast. This new classification system could affect drivers for apps like Uber and DoorDash, freelance designers, digital marketers, virtual assistants, consultants, writers, remote tech workers, basically anyone who works independently, from Toronto to Calgary, Halifax to Saskatoon. At first glance, it might seem like a step toward fairness, more benefits, more worker protections. But dig a little deeper, and you'll see the hidden costs. If gig workers are reclassified as traditional employees, companies may be required to contribute to benefits or payroll taxes. Sounds great, right? But here's the catch: many companies will likely reduce contracts, limit hours, or avoid hiring Canadian freelancers altogether to dodge the extra expense. That means fewer opportunities, more competition, and tighter margins. Plus, freelancers and contractors could lose access to valuable tax write-offs they've depended on, like home office expenses, mileage, equipment, and software. That's a huge financial hit for people who already live with income uncertainty. Remote workers who are technically based in Canada but working for U.S. or international companies may also face stricter income reporting, higher taxes, and possibly even location tracking to prove where they're working from. And here's another layer: you may be required to contribute to benefit programs or employment insurance, even if you'll never use them. This isn't just about paperwork. It's about changing the very nature of flexible work, something many Canadians turned to after the pandemic reshaped the job market. By 2026, the job that gave you freedom may start feeling more like a trap. Number 7. Health insurance contribution hikes. For decades, Canadians have taken comfort in knowing that health care is mostly covered. But by 2026, that safety net could start showing serious cracks, especially when it comes to how much you're expected to pay out of pocket. Across provinces like Ontario, British Columbia, Quebec, and Nova Scotia, governments are under pressure. An aging population, longer wait times, and rising costs of medication and services are forcing provinces to rethink how they fund healthcare. And that means you'll likely be paying more. We're not talking about massive premium hikes overnight. The changes will come quietly: new contribution tiers, higher monthly payments, or co-payments for services that used to be free. That includes things like diagnostic tests, certain prescriptions, or mental health consultations. These extra costs might not seem like much at first. But when combined with inflation, rent, mortgage payments, and everyday living expenses, they can push already stretched families into financial discomfort. The groups hit hardest: seniors living on fixed incomes, families with ongoing medical needs, and lower-income households who can't afford to add another bill to their budget. Some provinces are also exploring means-tested health contributions, meaning the more you earn, the more you pay, regardless of how often you actually use the system. And in rural or underserved areas, from northern Alberta to eastern Quebec, limited access to care means people might be paying more for less. Private health insurance plans are becoming more common, but not everyone qualifies. And those who do are often surprised by what isn't covered. As 2026 approaches, Canadians may begin to realize that universal health care is evolving, not vanishing, but shifting into a model where you're expected to contribute more, plan ahead, and take on a bigger share of the costs than ever before. Number 6. Vacancy and underused property fines. In 2026, one of the most quietly damaging changes to hit Canadian homeowners won't come from the housing market, it'll come from new penalties tied to how often your property is used. What began as a tax to stop foreign buyers from sitting on empty investment condos in cities like Vancouver and Toronto is now expanding, and ordinary Canadians are in the crosshairs. The updated vacancy and underused property rules will no longer target just offshore investors. By 2026, they could apply to second homes or cottages in places like Muskoka, Kelowna, or Prince Edward County. Inherited properties not yet sold. Homes under renovation or temporarily empty due to job relocation or family emergencies. And here's the problem: if you can't prove that your property is actively used, you could be hit with annual fines reaching into the thousands. What counts as active use? That's where things get complicated. You may need to submit utility bills, occupancy logs, signed rental agreements, or even security footage to show the property wasn't just sitting empty. Fail to meet the strict documentation requirements or miss the filing deadline. You could be fined automatically, even if you had a valid reason for the vacancy. Retirees, families holding onto vacation homes, and people managing properties across provinces, especially in areas like Niagara, Whistler, or the Laurentians, could suddenly find themselves tangled in paperwork, penalties, and appeals. And for many, this won't just be a financial nuisance. It could mean being forced to sell a home they intended to pass down or keep for family use. As this policy expands, the message is clear: if you own property in Canada, you're now expected to prove that it's being used, or pay the price. Number 5. National Digital ID System Integration. By 2026, Canada is expected to roll out a nationwide digital ID system, something that could completely change the way you access essential services, from healthcare to banking, taxes, and more. On the surface, it sounds like a step toward convenience. One digital identity that verifies who you are across platforms. But for millions of Canadians, especially seniors, rural residents, and those less comfortable with technology, this shift could quickly become a barrier rather than a benefit. Under this new system, you may need a verified digital ID just to file your taxes, renew your health card or driver's license, access banking features, apply for benefits or travel clearance, or even sign into certain government websites. Now imagine what happens if you lose access to that ID. A forgotten password, a hacked account, or a lost phone could suddenly lock you out of the services you rely on every day. And for people living in remote communities in Alberta, Northern Ontario, or parts of Atlantic Canada, where internet access is already limited, this digital shift could create major delays or service disruptions. Worse still, digital ID systems increase the risk of identity theft, data breaches, and surveillance. While the goal is security, centralizing personal data in one place makes it a prime target for cybercriminals. People who rely on paper-based documentation or infrequent internet use, like many in retirement communities, or those without smartphones, may find themselves excluded or left behind in this digital transition. While it's being marketed as modernization, the truth is, by 2026, if you're not digitally ready, you may be digitally locked out. And in a country where nearly everything is moving online, that's a risk no one can afford to ignore. Number 4. Small Business Compliance Overhaul. Running a small business in Canada is already tough: long hours, tight margins, and constantly changing market conditions. But in 2026, things could get even harder as a nationwide overhaul of small business compliance rules comes into effect. What's changing? Everything from how you report income and expenses, to mandatory insurance coverage, employee classifications, and even how often you're audited. This will apply to brick-and-mortar stores in places like Winnipeg and Regina, as well as freelancers, online sellers, and gig workers across Toronto, Edmonton, and beyond. Under these new rules, even solo entrepreneurs and part-time side hustlers could be expected to follow corporate-style reporting standards, tracking every payment, receipt, contract, and deductible with digital precision. Miss a form. Misclassify a contractor. Submit a late return. You could be facing hefty fines, red-flagged accounts, or even forced business closure. The government's goal is transparency and tax fairness. But the unintended consequence? Administrative overload for small operators who don't have an accountant on speed dial or the latest bookkeeping software. And for family-run shops, tutors, artists, fitness coaches, or home-based businesses, these new layers of regulation could eat into both time and profits. What used to be a simple weekend business might now require full-time paperwork, or risk being deemed non-compliant. Research shows that compliance costs for small businesses can rise by 20% to 30% when new rules like these are introduced, especially in sectors like construction, hospitality, wellness, and digital services. For many Canadians, 2026 might be the year they're forced to choose: either scale up their business to meet the new requirements, or shut it down altogether. Because in the new regulatory environment, being small and flexible could come with a heavy cost. Number 3. Carbon charges on utilities. If you think your utility bills are high now, brace yourself, because by 2026, mandatory carbon charges will be fully rolled out across electricity, heating, fuel, and other everyday essentials, making energy more expensive for millions of Canadians. This isn't just a policy on paper. It's a direct hit to your wallet, and it will show up every single month. These carbon surcharges are part of Canada's push to meet its aggressive climate targets. And while the environmental goals are important, the reality is that the cost of just living comfortably will rise, especially in provinces with harsh winters like Manitoba, Saskatchewan, Alberta, and parts of Quebec. Whether it's natural gas for heating, fuel for your car, or the electricity needed to keep the lights on, you'll likely see a noticeable increase on your bill, not from using more, but from the added carbon pricing. Studies show that carbon pricing can effectively reduce emissions over time, but it also has an immediate inflationary effect on essential goods and services. And for low to middle-income families, or those living in older homes, this can mean real financial strain. What's worse, rebate programs designed to offset these costs often don't reach everyone. Many households either don't qualify, or the rebates are too small to make a real difference. Farmers, small businesses, and residents in remote or rural areas, where energy alternatives are limited, may feel the impact even more. In places like Thunder Bay, Yellowknife, or rural Nova Scotia, the carbon charges could push people to make impossible choices between heating their home and cutting back on food or other essentials. By 2026, keeping your home warm in winter might not just be uncomfortable, it could become financially unsustainable. Number 2. Stricter mortgage renewal stress tests. For years, many Canadian homeowners have assumed that renewing a mortgage is simple: just sign the papers and move on. But by 2026, that assumption could come crashing down. New federal guidelines are expected to tighten mortgage stress test requirements, not just for first-time buyers, but for existing homeowners at renewal time. That means millions of people in cities like Toronto, Surrey, Calgary, and Mississauga could be forced to requalify for their own homes, at much higher interest rates. The stress test is designed to make sure you can afford your mortgage payments if rates rise. But here's the twist: even if you've never missed a payment, you could now be tested against rates 2 to 3% higher than what you're currently paying. And if you fail, you might not be able to renew with your current lender. That could leave you scrambling, looking for alternate lenders, agreeing to worse terms, or even facing the possibility of selling your home. This is especially alarming for homeowners who locked in low rates during the pandemic. As those terms expire, they'll be asked to prove they can handle massively higher payments, even though their income hasn't changed. According to financial experts, many middle-class households could see their mortgage costs jump by hundreds, even thousands, per month, purely due to stress testing and rate hikes. Seniors on fixed incomes, young families already stretching their budgets, and property owners with high debt ratios are among the most at risk. By 2026, renewing a mortgage won't just be paperwork, it could become a financial barrier that forces people out of homes they've lived in for years. And the most dangerous part: most homeowners have no idea this is coming. Number 1. Full wealth reporting requirements. By 2026, Canada may introduce one of its most sweeping financial policy shifts in recent history: a full wealth reporting requirement that goes far beyond your annual income tax return. Under this new framework, Canadians could be required to disclose a detailed inventory of their entire net worth, not just income, but homes, vehicles, investments, business assets, precious metals, collectibles, and even cryptocurrency holdings. The idea is to improve tax fairness and transparency. But in reality, it could place a heavy burden on middle-class families, especially those who've worked for decades to build modest financial security. Let's say you own a home in Oakville, have a rental condo in Burnaby, a small stock portfolio, and a used RV. Suddenly, all of that must be evaluated, documented, and submitted, with precise records and updated values. And here's the catch: if anything is misreported, undervalued, or missing, even by accident, you could face penalties, audits, or lengthy investigations that drain time, energy, and potentially money. Digital asset owners are especially vulnerable. Many Canadians dabble in crypto or hold online investments without fully tracking every transaction. But under these rules, even a minor oversight could trigger a compliance issue. For seniors, self-employed professionals, or those managing small family-owned businesses, keeping up with the documentation could become overwhelming, especially as asset values fluctuate constantly. This isn't just about the wealthy. It's about every Canadian who owns anything of value, and the new expectation that you must not only report what you earn, but what you own, in detail, every year. By 2026, the government won't just want to know how much you made. It will want to know exactly what you have, and how you got it. The rules are changing fast, and most people won't notice until it's too late. Tell us in the comments, which of these changes hit closest to home, and which one do you think others are still ignoring? If you haven't seen our last video, it connects directly to this, and could help you prepare even further. We pour countless hours into bringing you clear, no-fluff content, so if you found this helpful, please subscribe with just one click. It truly means the world to us.